Okay, so you want to own a sports team. You picture yourself in the owner's box, champagne in hand, your name on the front page after a championship parade, the whole city chanting because of a decision you made. You picture legacy, something your grandkids point to and say, that's ours. You picture being the smartest person in the room, because after all, you made the money to buy the thing in the first place. Sounds simple. It is not simple. Owning a professional sports franchise is one of the strangest financial instruments on the planet, part vanity project, part real estate play, part tax shelter, part 50-year bet on human obsession with watching other people run around. By the end of this, you'll understand exactly how this really works, what it actually costs, and why some of the richest people alive keep buying into a business that, on paper, barely makes sense. Let's start with the price of admission. Depending on the league, buying in ranges from a genuinely shocking $30 million to $50 million for a lower-tier minor league or niche pro franchise, all the way up to $4 billion to $6 billion for a marquee NBA or NFL team in a major market. The cheap options exist for a reason: smaller media markets, weaker local TV deals, older stadiums with fewer luxury suites, and a fan base that simply generates less revenue per seat. Here's the trap that catches new buyers off guard: the purchase price is just the entrance fee. On top of it, most leagues require new owners to keep tens of millions in liquid reserve capital, cover the team's share of stadium debt if one exists, and often pay a league entry or transfer fee that can run another 5 to 10% of the deal on top. People budget for the sticker price. They don't budget for the 2 years of quiet bleeding that follows. So how does a team actually make money? Here's where it gets interesting, because it's not really one business, it's 4 or 5 businesses stapled together. Layer 1 is media rights. This is the biggest and most counterintuitive piece. National broadcast and streaming deals get split roughly evenly across every team in the league, meaning a team playing in a stadium that's half empty every night can still collect $100 million to $300 million a year just for existing under the league's umbrella. Read that again. The biggest market team and the smallest market team often get paid almost the same amount from the national pot. Layer 2 is local revenue, ticket sales, local broadcast deals, and in-stadium sponsorships. This is where market size actually matters, and it's why a team in a massive metro area can outearn a small market team by hundreds of millions annually, even if both are mediocre on the field. Layer 3 is the counterintuitive one: merchandising and licensing. You'd assume the star players' jersey sales fund the team directly. They don't, mostly. Most leagues pool merchandise revenue and split it, so an unpopular team benefits from a superstar on another roster. The biggest name literally pays the least into your specific bank account. Layer 4 is the stadium itself: parking, concessions, non-game events like concerts, and increasingly, real estate development around the venue. Think of the team almost like a magnet. It's not just selling tickets, it's pulling foot traffic that turns the surrounding land into bars, hotels, and retail that the ownership group often owns too. Layer 5, and this one sneaks up on people: franchise appreciation. Teams have historically appreciated in value faster than almost any other asset class over the last 2 decades, sometimes tripling or quadrupling in a single decade of ownership, regardless of whether the team ever wins anything. Now for the part the glossy pitch decks leave out. First, player payroll. In leagues with salary caps it's controlled, but in leagues without one, payroll can swing from $150 million to $300 million a year with almost no warning, especially in a bidding war for a star free agent. Second, stadium maintenance and upgrades. An aging venue can require $200 million to $500 million in renovations just to stay competitive for events and sponsorships, and owners are frequently on the hook for a meaningful chunk of that even when public financing is involved. Third, and this is the one that can cascade: on-field losing. A bad season doesn't just cost you wins, it costs you local sponsorship renewals, it costs you season ticket retention, which costs you local media leverage, which costs you your next local broadcast deal. One bad stretch can knock dominoes through almost every revenue layer at once. Here's a quick, composite case study, the kind you've probably half heard before: A group buys a struggling mid-market franchise for what looks like a bargain, promising a quick turnaround through free agency spending and a flashy new arena. The team overspends on payroll, the arena project balloons in cost and gets delayed 2 years, and by the time it opens, the roster is aging and the local fan base has moved on. The franchise's value still climbs anyway, purely because the league's national deals kept growing around them. The takeaway: you can lose on the field for a decade and still win on the balance sheet, and that single fact explains almost everything else about who buys these teams. Let's talk about a good year versus a bad year. In a good year, a mid to large market team can post $40 million to $80 million in operating income, driven by a deep playoff run, strong local sponsorship renewals, and a healthy merchandise cycle. Add franchise appreciation on top of that, and the owner's net position for the year can look extraordinary even before accounting for cash flow. In a bad year, a losing season, an injury to the franchise player, a sponsorship pullback, that same team can see operating income shrink to break even or even post an operating loss of $10 million to $20 million, especially if payroll stayed high while local revenue softened. The gap between those 2 years isn't small. It's the difference between a business that prints money and one that quietly drains it, and most owners will experience both within the same 5-year stretch. So why do sophisticated buyers keep lining up for this, knowing all of that? Here's the insider secret: sports teams are one of the most efficient tax and estate planning tools available to the ultra-wealthy. Franchise ownership allows for depreciation write-offs on player contracts and intangible assets that can meaningfully offset other income, even while the asset itself appreciates. It's also one of the last true trophy assets. Unlike a stock portfolio, there's essentially a fixed, artificially scarce supply of franchises in any major league, and leagues actively control who's allowed to buy in, which itself creates exclusivity-driven value. Add the soft benefits: access, influence, a permanent seat at the table in a city's civic life, and you start to understand why billionaires who could park their money in far less volatile investments choose this instead. It's not really about the annual profit and loss statement. It's about owning a piece of scarcity that happens to also make the news every night. And that's really the whole story here. A sports team isn't a business in the traditional sense, it's a cultural asset wrapped in a balance sheet, and the emotional return is doing just as much work as the financial one. People don't buy these teams because the math is clean. They buy them because for the price of a mid-sized company, they get to own something a city loves, argues about, and can never quite replace, and it turns out that in this economy, scarcity like that is worth almost any price.